Hello everyone and welcome to my second video on interpreting financial statements. The financial statement that I'm going to look at today is the profit and loss account, which is often called the statement of comprehensive income. So what this is it's a record of all the business's revenues and costs within a year, or within a trading period. Basically, these have to be published by limited companies and public limited companies by law. So if you are a company director and your company does not publish these, you can be fined by the HMRC, according to the HMRC website. So it's really important that these things are published. So we're going to talk about what some of the components of the profit and loss account are. So over here we have a very kind of primitive look at what the profit and loss account is. It starts with the company's revenue over the course of the year, and it goes through to how much profits they're making at the end. Right, so let's talk you through the process. So the revenue is the price times quantity. It's all the money that's coming into the business from sales. So if they have separate products, it's all of those products added together, all of that finance, all of that money that's coming into the business is put down to as revenue. So in this case, this business is making £26 million worth of revenue each year. Now, after that, we have the cost of sales. So the cost of sales is all the costs that are associated with selling those goods. So these are mainly things like variable costs. They include packaging, materials, so all the costs that are associated with that. Now, after that, we get to our first type of profit. So we take our revenue, take away our cost of sales, we get our gross profit. So this is all the profit after our cost of sales have been paid for. This can be improved either by increasing your revenue or reducing your cost of sales. Moving on from that, we have our overheads. So as you can see, negative figure in brackets, as was the cost of sales. The overheads are the other costs for the business. So these are mainly the fixed costs, but they include things like wages, salaries, rents, heat, light, insurance. So all of those other costs come under overheads. And then if you take away your overheads from your gross profit, you get our second type of profit, which is the operating profit. Now the operating profit is really important for our return on capital employed, which is the primary ratio which most businesses are measured by. So that's really important to consider. Following that, we have our finance costs. So our financing costs are things like if the business has taken out a loan, it will have to pay insurance on that. Not insurance, they have to pay interest on that loan. And that would come under financing costs. But it could also be that that business owns shares in another business. So those other businesses are going to pay out dividends to your business in question. So that their financing costs could actually be making the business money, as is the case here. Maybe they've got savings that they're receiving an interest rather than paying out an interest on the loan. Maybe they're getting dividends from their shares in another business. In this case, they're making £1.5 million of profit from elsewhere. So that comes into the profit and loss account. And then the profit before tax, our third type of profit, is adding on our financing costs onto our operating profit. So in this case, 5 at our 1.5 give us £6.5 million worth of profit. There are two things that are certain in life: death and taxes. And this business is paying £2 million worth of tax here. So if we take that away from our profit before tax, we get our final profit for the year of 4.5 million. Often a profit and loss account will have another two items at the bottom. One is the number of shares that are in circulation, and the other one is the profit per share. So if you divide your profit for the year by the number of shares, you should get how much dividends is being paid out for every shareholder. Profit is very important for the business. One, as mentioned, it could be used to pay out dividends to the shareholders, so that there's actually a reward for owning some of the business. And the other thing is that profit can be put into further investment. So, if they want to buy a new machine and things like that, they can use retained profit in order to further the business's productive capacity, or put it into marketing, or make further investments to improve the business. As I mentioned earlier, the profit and loss account has to be published by law, by limited companies and PLCs, and there are various stakeholders who have an interest in the profit and loss account. First of all, the shareholders. They really want to see how much profit their business is making. What's the likelihood of them receiving higher dividends? And if potentially you were going to invest in this business, you'd want to see how profitable it is. Following that, we have managers, because managers can look at this and see where are the biggest costs, what can we do to improve our profitability. So think about, can we reduce our overheads, can we reduce our cost of sales? The two big expenditures is our tax bill too high? Do we need a better accountant? All of these things managers can think about in order to meet profit targets. Government want to see this because whilst the managers might want to reduce the tax bill, the government want to see whether this business is paying its taxes so that it can fund roads and infrastructure and hospital and schools and all the things that you would expect a responsible government to be providing. Good. And then our suppliers, they want to see whether a business is making profit as to whether they should be giving them any trade credit or not. I mean, they wouldn't want to give any trade credit to a business that was unable to pay its bills, that wasn't making any profit, because they'd be giving trade credit, and then ultimately there's a good chance that they might lose the money that they're owed if the business goes bankrupt. So suppliers are really keen to see a profit and loss account to see if a business can continue to function. And similarly, the banks want to be able to see a profit and loss account because they want to, if they're going to lend money to a business, they want to see whether a business is able to pay them back on their loans. So it's really important for that. And the other thing is, it doesn't tell us about the environment in which the business is operating. It doesn't tell us, unless you've got year-on-year profit and loss accounts, we can't see the trends that are happening. Or so you could if you have the various year-on-year statements. It doesn't tell us whether the business has become unpopular, what's happening in terms of marketing. It doesn't tell us what's happening with the other stakeholders. So there are limits to the profit and loss account. Anyway, I hope that's been useful to you. The profit and loss account's really useful for looking at, you need to know about it for the profitability ratios, and also helps with calculating return on capital employed. So make sure you're really you're comfortable dealing with the profit and loss account when it's there. Anyway, see you next time.